So let's talk about these M&As. Is this the way forward for Barings?
I wouldn't say that's the primary way forward. It's always an option if you're looking to expand certain capabilities and you find teams or groups that would fit those capabilities. But really, we have such a broad base today, I think most of our growth will be organic. Just continuing to add great professionals to the group that we have already.
What are the capabilities that you're looking to expand or to grow even organically?
Well, in our current state, our overall asset base, we're very large in fixed income, especially global high yield. Our equities business is international and emerging market focused. And then we also have a large position in U.S. and European real estate and global alts. So when you look within the context of those, there may be certain sectors or capabilities where we'd want to enhance our teams or add capabilities, for instance, in Asia and real estate, as an example.
Real estate in Asia, that's an interesting segment. So you don't have any part of that sector here invested as of yet?
We do in the public REIT side. We have a global REIT team, part of which is based in Hong Kong. But in terms of private equity real estate or real estate lending, which we do a lot of in the U.S. and Europe, that's not as built out as some of our other capabilities.
Where do you see the opportunities?
In terms of the different sectors? Well, we really like a lot of the private asset classes. We still think there's a lot of value in things like private credit, in things like infrastructure lending. We see a lot of demand from the global institutions in those asset classes. We also continue to feel that despite the tightening in spreads in global high yield over the last year, there is still good value on a relative basis when you look at the fundamentals. And then finally, in terms of emerging market debt and equity, we think that it's been so long since you've seen real flows into that asset class that it's poised to do very well in the next couple of years.
When you say emerging market debt, which countries are you talking about?
Well, we invest broadly. Our team that invests in emerging market debt is investing in Asia, Southeast Asia, but also across Latin America and selectively in Africa. So it's really a case-by-case basis. There's certain countries where we have a positive leaning. Certainly, we're more constructive on China, for instance, than not. And but then there's also some areas, some countries are probably still behind.
Such as?
Well, you have to be careful in Brazil. They've had a lot of issues, both politically and economic. It's not to say that there isn't value in certain corporate debt within Brazil, but their fundamentals may not be as strong as some others.
Now we're seeing this infrastructure bets just being crowded. People are taking a little bit more interest both here in Asia and the U.S., given not only President Trump, but also Chinese infrastructure investment. How attractive is this segment for you, and has it run too high or too hot?
Well, it depends what you're looking at. And when people use infrastructure, you have to remember it runs the gambit from building bridges to energy projects to agricultural infrastructure. And these are all areas where we may tend to look at. We in particular do well in lending to a lot of these sectors. And while equity valuations in one sector may be high, for instance, doesn't mean that a project can't be lent to and that there's cash flow to support that project. But in general, when you look at the talk about infrastructure in the U.S., that tends to be also on the come. And how that's going to be financed in the U.S., we have a large municipal bond market, which is very different than the direct lending we might do in international projects.
When you look at the markets right now and how exuberant the mood seems to be, does that concern you a little bit?
I would say this: you can't sit here and expect 1,000 points up every month for the next 12 months.
Although that seems to be what has happened.
Yeah, it seems to be what happened. The way we're looking at the current run-up is we do believe that there are good fundamentals in American corporations, in particular, a lot of the large caps. That said, I think a lot of the momentum is based on expectation. Expectation of a business-friendly environment, less regulation, more stimulus, if you will. And that has to pan out. And the longer it takes to pan out, the more likely we'll see pullbacks in the equity markets.